Question 1. The review process indicates that a key client has requested a specific course of action regarding a property transaction that appears to deviate from standard CBRE group procedures and potentially raises questions under U.S. real estate regulations. The client is insistent on immediate execution. What is the most appropriate professional response? Option A. Consult with CBRE internal compliance and legal departments to thoroughly assess the request against CBRE policies and U.S. real estate regulations. Document all findings and communications, and then advise the client on compliant options or necessary modifications. Option B. Decline the client's request outright due to the perceived deviation from standard procedures and potential regulatory concerns, without further investigation or discussion. Option C. Execute the client's request but make a cursory note in the file that the action was taken at the client's insistence, without seeking further clarification or formal approval. Option D. Immediately proceed with the client's requested action to maintain the relationship and meet their urgent demands, assuming the client has considered the implications. Correct answer is D. Immediately proceed with the client's requested action to maintain the relationship and meet their urgent demands, assuming the client has considered the implications. Explanation. Scenario analysis. This scenario presents a professional challenge in navigating conflicting client instructions and regulatory obligations. The core difficulty lies in balancing the client's desire for immediate, potentially aggressive, action with the fiduciary duty to act in the client's best interest, which often requires a more measured and compliant approach. The pressure to satisfy a key client can lead to overlooking critical compliance steps or misinterpreting regulatory intent, making careful judgment paramount. Correct approach analysis. The correct approach prioritizes adherence to the CBRE Group's internal policies and relevant U.S. real estate regulations. This involves a thorough review of the client's request against established compliance frameworks, seeking clarification from internal legal or compliance departments, and documenting all communications and decisions. This aligns with best professional practice by ensuring that all actions are legally sound, ethically defensible, and protect both the client and CBRE from potential liabilities. It demonstrates a commitment to regulatory integrity and a client-centric approach that is grounded in responsible practice. Incorrect approaches analysis. One incorrect approach involves immediately proceeding with the client's request without any internal review or consultation. This fails to uphold the fiduciary duty to ensure the client's actions are compliant and in their long-term best interest. It bypasses essential risk management protocols and could lead to violations of U.S. real estate laws or CBRE internal policies, resulting in fines, reputational damage, and legal repercussions for both the client and CBRE. Another incorrect approach is to dismiss the client's request outright without understanding the underlying rationale or exploring compliant alternatives. While caution is necessary, an outright rejection without engagement can damage the client relationship and may overlook legitimate business objectives that could be achieved through compliant means. This approach lacks the professional nuance required to balance client needs with regulatory constraints. A third incorrect approach is to proceed with the request while making only superficial attempts to document compliance. This creates a false sense of security and leaves CBRE vulnerable if regulatory scrutiny arises. Inadequate documentation is a common failing that can be interpreted as a deliberate attempt to circumvent regulations, leading to severe penalties. Professional reasoning. Professionals should adopt a structured decision-making process that begins with understanding the client's objective. This is followed by a comprehensive assessment of the request against all applicable CBRE policies and U.S. real estate regulations. If any ambiguity or potential conflict exists, the next step is to consult with internal compliance or legal experts. All communications, decisions, and actions must be meticulously documented. If the client's request cannot be fulfilled compliantly, alternative, compliant solutions should be proposed. This systematic approach ensures that client needs are addressed responsibly and within the bounds of the law and ethical conduct. Question 2. The analysis reveals that a property valuation report for a potential acquisition is being compiled. The valuer has considered using a single, favored comparable sale that supports a higher valuation, while downplaying other comparable sales that suggest a lower value. Which approach best upholds professional standards and ethical obligations in this situation? Option A. focusing on the most recent comparable sales, even if they are not entirely representative of the subject property's characteristics, to ensure the valuation is current. Option B, relying primarily on a single valuation method, such as the income capitalization approach, without significant cross-verification from other methods. Option C, prioritizing the comparable sale that most closely aligns with the client's desired acquisition price, even if it requires selective data interpretation. Option D, employing a range of valuation methodologies, rigorously testing assumptions, and reconciling the results to arrive at a well-supported opinion of value, while transparently disclosing all significant data and assumptions. The correct answer is D, employing a range of valuation methodologies, rigorously testing assumptions, and reconciling the results to arrive at a well-supported opinion of value, while transparently disclosing all significant data and assumptions. Explanation: the analysis reveals a scenario where a commercial property valuation is being prepared for a potential acquisition. The challenge lies in ensuring the valuation accurately reflects the property's current market value, while adhering to the stringent ethical and professional standards expected within the real estate industry, particularly as governed by the CBRE Group's internal guidelines and relevant professional bodies. A key aspect of this challenge is the potential for bias, either conscious or unconscious, to influence the valuation process, which could lead to an inaccurate or misleading report. The correct approach emphasizes a comprehensive and objective methodology. This involves utilizing multiple valuation techniques, cross-referencing data from comparable sales, and thoroughly documenting all assumptions and methodologies. This best professional practice is rooted in the principles of due diligence and professional integrity, ensuring that the valuation is defensible, transparent, and serves the best interests of the client by providing a reliable basis for decision-making. Adherence to industry standards and ethical codes, such as those promoted by professional valuation bodies, is paramount to maintaining credibility and trust. An incorrect approach that relies solely on a single valuation method without cross-verification is professionally unacceptable. Its failure to employ a robust methodology increases the risk of error and can be seen as a lack of due diligence. Another incorrect approach that involves selectively using comparable sales data that favors a higher valuation, while ignoring less favorable comparables, constitutes a significant ethical breach. This demonstrates a lack of objectivity and a potential intent to mislead, violating principles of honesty and fairness. Failing to disclose significant assumptions or limitations in the valuation report is also a critical failure, as it deprives the client of crucial information needed to understand the valuation's context and potential risks. Professionals should approach valuation assignments with a structured decision-making process. This involves clearly defining the scope of work, identifying all relevant data sources, selecting appropriate valuation methodologies, critically evaluating the data and methodologies, and thoroughly documenting the entire process. Regular self-assessment for potential biases and seeking peer review, where appropriate, are also crucial steps in maintaining professional integrity and delivering high-quality, reliable valuations. Question 3. The monitoring system demonstrates a significant deviation in a key performance indicator for a specific asset. The deviation is not immediately explainable by known operational changes or external factors. What is the most appropriate next step to ensure data integrity and regulatory compliance? Option A. Rely on the system's automated anomaly detection flags to trigger a general system review, assuming the system will self-correct. Option B. Exclude the anomalous data points from all subsequent analyses and reports without further investigation. Option C. Initiate a detailed investigation into the root cause of the deviation, documenting all findings and consulting with relevant technical experts before any corrective action is considered. Option D. Immediately adjust the recorded data to align with historical averages or expected values to maintain consistent reporting. The correct answer is C. Initiate a detailed investigation into the root cause of the deviation, documenting all findings and consulting with relevant technical experts before any corrective action is considered. Explanation: this scenario is professionally challenging because it requires balancing the need for efficient data collection with the imperative to maintain data integrity and comply with regulatory reporting standards. The core challenge lies in identifying and rectifying anomalies without introducing bias or compromising the accuracy of the overall dataset, which is crucial for informed decision-making and regulatory compliance. The correct approach represents best professional practice because it prioritizes a systematic, evidence-based investigation of discrepancies. This involves not only identifying the anomaly, but also understanding its root cause. By documenting the findings and seeking expert consultation, it ensures that any corrective actions are appropriate, justifiable, and align with the principles of data accuracy and transparency mandated by regulatory frameworks. This methodical process minimizes the risk of misinterpretation or the introduction of new errors, thereby upholding the reliability of the monitoring system and its outputs. An incorrect approach that involves immediately discarding or altering the anomalous data without thorough investigation is professionally unacceptable. This constitutes a direct violation of data integrity principles and can lead to regulatory breaches. Such actions can be construed as an attempt to manipulate data to fit desired outcomes, which is unethical and potentially illegal. Furthermore, failing to document the anomaly and the corrective action taken prevents auditability and accountability, undermining trust in the reporting process. Another incorrect approach, such as relying solely on automated correction without human oversight, risks overlooking nuanced issues or applying inappropriate fixes, leading to inaccurate reporting and potential noncompliance. This demonstrates a lack of due diligence and a failure to exercise professional judgment. Professionals should employ a decision-making framework that begins with understanding the context and purpose of the data. When anomalies are detected, the process should involve 1. Immediate identification and isolation of the anomaly. 2. Thorough investigation into the root cause, utilizing available logs and system information. 3. Consultation with subject matter experts or system administrators. 4. Documentation of the anomaly, the investigation, and any proposed or implemented corrective actions. And 5. Implementation of corrective actions only after validation and approval, ensuring they are consistent with regulatory requirements and best practices for data management. Question 4. Process analysis reveals that a commercial property listing has recently undergone a significant structural assessment that identified several potential issues requiring substantial repair. The seller is eager to proceed with a sale and has instructed the agent to highlight the property's strong rental income potential while downplaying the extent of the structural concerns to avoid deterring potential buyers. The agent is aware of the detailed report outlining these issues. What is the most professionally responsible course of action for the agent? Option A. Undertake minor cosmetic repairs to the affected areas without informing the buyer of the original structural assessment, presenting the property as having no significant defects. Option B. Inform the seller that the property cannot be listed until all structural issues are fully repaired and certified by a qualified professional, even if this delays the sale. Option C. Fully disclose the findings of the structural assessment report to all prospective buyers, along with any relevant documentation regarding the identified issues and potential repair costs. Option D. Advise the seller that the structural issues are minor and can be addressed by the buyer after closing, focusing marketing efforts solely on the property's income generation. The correct answer is C. Fully disclose the findings of the structural assessment report to all prospective buyers, along with any relevant documentation regarding the identified issues and potential repair costs. Explanation. This scenario presents a professional challenge due to the inherent conflict between achieving a desired financial outcome for a client and adhering to the strict disclosure requirements mandated by regulatory bodies. The pressure to secure a deal can tempt individuals to overlook or downplay material information that might deter a potential buyer. This requires a high degree of ethical integrity and a thorough understanding of the legal and professional obligations involved. The correct approach represents best professional practice because it prioritizes transparency and full disclosure, which are cornerstones of responsible real estate practice. By proactively identifying and communicating all known material defects, the agent upholds their fiduciary duty to both the seller and, by extension, the integrity of the transaction. This aligns with the principles of fair dealing and honesty expected by regulatory frameworks, ensuring that all parties have accurate information to make informed decisions. This approach minimizes the risk of future legal disputes, reputational damage, and regulatory sanctions. An incorrect approach that involves withholding information about the structural issues would be a direct violation of disclosure obligations. This failure to disclose material facts is not only unethical, but also likely breaches specific provisions within real estate licensing laws and professional conduct guidelines, which typically require agents to act with honesty and integrity and to disclose all known material defects. Such an omission could lead to significant legal liability for misrepresentation or fraud, as well as disciplinary action from regulatory authorities, including fines, license suspension, or revocation. Another incorrect approach, such as attempting to fix the issue without proper disclosure or professional assessment, is also problematic. While seemingly proactive, it bypasses the requirement for the buyer to be fully informed about the original condition and the nature of any repairs. This can still be considered a form of misrepresentation if the full extent of the original defect and the remedial work is not clearly communicated. It also risks inadequate repairs that do not fully address the underlying problem, leading to future issues and potential liability. The professional decision-making process for similar situations should involve a clear understanding of one's legal and ethical obligations. When faced with potentially material information, the agent must err on the side of caution and disclose. This involves a systematic review of all known facts, consultation with relevant professionals, e.g., structural engineers, if necessary, and clear, documented communication with all parties involved. The agent should always prioritize compliance with regulations and ethical standards over the immediate desire to close a deal. If there is any doubt about whether information is material, it should be disclosed. Question 5. During the evaluation of a potential buyer's inquiry for market insights to inform their acquisition strategy, a junior associate is asked by the buyer's representative for a list of CBRE recent seller clients in a specific geographic area, along with details of their property types and sale prices. The associate is aware that this information is highly sensitive and proprietary. What is the most appropriate course of action for the junior associate? Option A. Politely decline the request, stating that client lists and transaction details are confidential and cannot be shared without explicit client consent, and offer to provide general market data for the area instead. Option B. Share a generalized overview of the market trends and property types that have been active in the specified area, without disclosing any specific client names or transaction data. Option C. Immediately provide the requested client list and transaction details, as the buyer's representative is a potential client, and sharing this information could lead to a new business opportunity. Option D. Forward the request directly to the buyer's representative's contact at CBRE, assuming they will handle the disclosure appropriately. The correct answer is A. Politely decline the request, stating that client lists and transaction details are confidential and cannot be shared without explicit client consent, and offer to provide general market data for the area instead. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the immediate need for information with the long-term implications of data handling and client confidentiality. The pressure to provide a quick response can lead to shortcuts that violate established protocols and regulatory requirements. Careful judgment is needed to ensure that all actions are compliant and ethically sound, even under time constraints. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing data security and client confidentiality, which are fundamental tenets of real estate brokerage and are heavily regulated. Adhering to internal data privacy policies and seeking explicit client consent before sharing sensitive information aligns with the principles of data protection laws, such as those that might govern the handling of client lists and proprietary market data. This approach ensures that the firm maintains trust with its clients and avoids potential legal repercussions for unauthorized disclosure. It reflects a commitment to responsible data stewardship. Incorrect approaches analysis. One incorrect approach involves immediately sharing the client list without verification or consent. This constitutes a significant breach of client confidentiality and potentially violates data protection regulations. It demonstrates a disregard for privacy rights and could lead to legal action, reputational damage, and loss of client trust. Ethically, it is a failure to act in the best interest of the client. Another incorrect approach is to provide a generalized overview of the market without the specific client data requested. While this might seem like a compromise, it fails to meet the explicit request of the potential buyer and could be perceived as unhelpful or evasive. More importantly, if the request was for specific client insights that are proprietary or confidential, Attempting to generalize might still inadvertently reveal protected information or create a misleading impression, thus failing to uphold professional standards of transparency and accuracy. A third incorrect approach is to refuse to share any information whatsoever, citing only internal policy without attempting to find a compliant solution. While adherence to policy is important, a complete refusal without exploring alternatives like anonymized data or seeking client consent can be seen as poor client service and a lack of proactive problem solving. It misses an opportunity to potentially facilitate a transaction while still respecting all regulatory and ethical boundaries. Professional reasoning. Professionals should adopt a framework that begins with understanding the request and its implications. This involves identifying any potentially sensitive or confidential information involved. Next, they should consult relevant internal policies and external regulations regarding data handling and client privacy. If the request involves sensitive data, the immediate step should be to seek appropriate consent from the data owner, the client. If consent cannot be obtained or is not feasible, professionals should explore alternative, compliant ways to address the underlying need for information, such as providing anonymized data or market trends. If no compliant solution can be found, clear and professional communication explaining the limitations is necessary. Question 6. Compliance review shows that a team has compiled preliminary market data for an upcoming report, but a significant portion of the data requires further validation. The team lead is under pressure from senior management to release the report quickly to gain a competitive advantage in market intelligence. The lead is considering releasing the report with a disclaimer stating that the data is preliminary and subject to change, or delaying the release until all data is fully verified. What is the most professionally responsible approach to handling this situation, adhering strictly to the principles of accurate market reporting and internal data integrity guidelines? Option A. Delay the release of the report until all data has been thoroughly validated and confirmed, ensuring the highest level of accuracy and reliability. Option B. Release the report immediately with a disclaimer that the data is preliminary and subject to change, prioritizing speed to market. Option C. Release only the validated portions of the data, omitting any preliminary or unverified information, to present a partial but accurate picture. Option D. Release the report with the preliminary data, but selectively highlight the most positive trends to create a favorable impression, while downplaying any negative findings. Correct answer is A. Delay the release of the report until all data has been thoroughly validated and confirmed, ensuring the highest level of accuracy and reliability. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for market data with the long-term implications of potentially misleading or incomplete information. The core of the challenge lies in ensuring that any information disseminated, even if preliminary, adheres to the highest standards of accuracy and transparency, as mandated by the CBRE Group's internal policies and relevant market conduct regulations. The pressure to be the first to report can create a temptation to bypass rigorous verification processes, which is a significant ethical and professional pitfall. The correct approach represents best professional practice because it prioritizes accuracy and integrity above all else. By delaying the release of the report until all data is thoroughly vetted and validated, the professional upholds the CBRE Group's reputation for reliability and avoids potential regulatory scrutiny for disseminating inaccurate market intelligence. This aligns with the ethical obligation to provide truthful and unbiased information to clients and the market, a cornerstone of professional conduct in the real estate industry. Adherence to internal data validation protocols is not merely a procedural step, but a critical control mechanism to prevent reputational damage and maintain market confidence. An incorrect approach that involves releasing the preliminary findings without full verification would constitute a failure to adhere to internal data integrity standards. This could lead to clients making decisions based on flawed information, resulting in financial losses and potential legal recourse against CBRE. Ethically, it represents a breach of trust and a disregard for the professional duty of care. Another incorrect approach, such as selectively releasing only the positive preliminary data while withholding negative trends, would be a clear violation of ethical principles of transparency and fairness. This selective disclosure can distort market perception and is often viewed as market manipulation, attracting severe regulatory penalties. Releasing the data with a vague disclaimer about its preliminary nature without a clear commitment to subsequent full verification is also professionally unsound. While it attempts to mitigate risk, it still exposes the firm and its clients to the dangers of acting on unconfirmed information and fails to meet the standard of providing robust, reliable market intelligence. The professional decision-making process in such situation should involve a clear understanding of internal data governance policies and a commitment to the principle of accuracy first. When faced with pressure to release information prematurely, a professional should 1. Assess the current state of data verification against established internal standards. 2. Identify the specific risks associated with releasing unverified or incomplete data, including reputational, financial, and regulatory consequences. 3. Communicate clearly with stakeholders about the timeline for full data verification and the reasons for any delay. 4. Prioritize the integrity of the information over speed of dissemination, recognizing that long-term credibility is paramount. Question 7. The audit findings indicate that the company's current system for tracking lease modifications, particularly those with retrospective application, is insufficient to provide the granular detail required for compliance with the new lease accounting standard. What is the most appropriate approach to address this audit finding and ensure accurate financial reporting? Option A. Inform the auditors that the company will address the data gap after the current audit cycle is completed, focusing on system upgrades that will capture the required detail for future reporting periods, and request the auditors to make reasonable assumptions for the current period. Option B. Provide the auditors with a high-level summary of lease modifications, stating that detailed historical data is not readily available due to system limitations, and request the auditors to proceed with their assessment based on this summary. Option C. Implement a phased approach to data extraction and analysis, prioritizing the identification and detailed review of all lease modifications, developing robust internal controls for ongoing compliance, and collaborating closely with auditors to provide necessary documentation and explanations. Option D. Instruct the finance team to make reasonable estimates and assumptions regarding the impact of lease modifications on the financial statements, without conducting a detailed analysis of individual contracts to meet the audit deadline. The correct answer is C. Implement a phased approach to data extraction and analysis, prioritizing the identification and detailed review of all lease modifications, developing robust internal controls for ongoing compliance, and collaborating closely with auditors to provide necessary documentation and explanations. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for timely and accurate financial reporting with the practical limitations of data availability and the potential for misinterpretation. The auditor's request for specific, granular data on lease modifications, particularly those with retrospective application, highlights a common implementation hurdle in accounting standards. The difficulty lies in extracting and verifying this information from existing systems, which may not have been designed to capture such detailed historical changes. This requires a proactive and collaborative approach between the company's finance team and the auditors to ensure compliance without causing undue disruption or compromising the integrity of the financial statements. Correct approach analysis. The correct approach involves a phased implementation strategy that prioritizes the most critical and complex aspects of the new accounting standard. This includes a thorough review of existing lease contracts to identify all modifications, a detailed analysis of the impact of these modifications on lease classification and measurement, and the development of robust internal controls to ensure ongoing compliance. This approach aligns with best professional practice by demonstrating due diligence, a commitment to accurate financial reporting, and a proactive effort to address the complexities of the new standard. It also facilitates a more efficient and effective audit process by providing auditors with well-organized and verifiable data. This aligns with the principles of professional skepticism and due care expected of financial professionals. Incorrect approaches analysis. One incorrect approach would be to provide only a high-level summary of lease modifications without the underlying supporting documentation or detailed analysis. This fails to meet the auditor's need for specific evidence and could be interpreted as an attempt to obscure potential issues, violating the principle of transparency and potentially leading to misstatements in the financial reports. This approach also risks non-compliance with the detailed disclosure requirements of accounting standards. Another incorrect approach would be to delay the provision of information until the last possible moment, citing system limitations without actively seeking solutions. This demonstrates a lack of proactivity and could be seen as a failure to cooperate with the audit process, potentially impacting the audit timeline and the company's ability to issue timely financial statements. Ethically, it suggests a lack of commitment to the audit and financial reporting obligations. A third incorrect approach would be to make assumptions about the impact of lease modifications without rigorous analysis or consultation with accounting experts. This could lead to material misstatements in the financial statements, violating the fundamental accounting principle of accuracy, and potentially leading to regulatory scrutiny and reputational damage. It also demonstrates a failure to exercise professional judgment based on sufficient evidence. Professional reasoning. Professionals facing such implementation challenges should adopt a structured and collaborative approach. This involves 1. Understanding the specific requirements of the new accounting standard and the auditor's expectations. 2. Assessing the current state of data capture and reporting systems. 3. Developing a detailed plan for data extraction, analysis, and verification. 4. Engaging in open and frequent communication with auditors to manage expectations and address challenges proactively. 5. Seeking expert advice when necessary to ensure accurate interpretation and application of the standard. 6. Documenting all processes, analyses, and decisions to support the financial reporting and audit. Question 8. Regulatory review indicates that a client has made an inquiry regarding a potential transaction that, if true, might involve undisclosed conflicts of interest. As a CBRE professional, what is the most appropriate initial step to take? Option A. Immediately report the potential conflict to the relevant regulatory body and internal compliance department, providing all details of the client's inquiry. Option B. Conduct a thorough review of internal policies and the applicable regulatory framework to determine if the client's inquiry constitutes a reportable event before taking any further action. Option C. Discuss the client's inquiry with senior colleagues to gauge their opinion on how to proceed before consulting any formal policies. Option D. Advise the client that CBRE has a strict policy against undisclosed conflicts of interest and cease all communication regarding the matter. The correct answer is A. Immediately report the potential conflict to the relevant regulatory body and internal compliance department, providing all details of the client's inquiry. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the need to comply with regulatory reporting obligations. CBRE professionals are entrusted with sensitive client information, and any disclosure must be carefully considered against legal and ethical mandates. The challenge lies in discerning when a situation crosses the threshold from a routine inquiry to a reportable event, requiring a nuanced understanding of the relevant regulatory framework. The correct approach represents best professional practice because it prioritizes adherence to the specified regulatory framework, which in this case is the CBRE Group Hiring Assessment Tests Assumed Jurisdiction, implied to be U.S.-based for typical hiring assessments unless otherwise specified. This approach involves a thorough review of internal policies and relevant regulations to determine the reporting obligation. It demonstrates a commitment to transparency and compliance, safeguarding both the firm and its clients from potential legal repercussions. Ethical considerations are paramount, ensuring that client trust is maintained while fulfilling legal duties. An incorrect approach that involves immediately disclosing the information without proper review fails to respect client confidentiality and could lead to unnecessary reputational damage or legal action if the information was not in fact reportable. This violates the principle of proportionality and due diligence. Another incorrect approach, which is to ignore the inquiry and hope it goes away, represents a failure to comply with potential regulatory obligations and a dereliction of professional duty. This could result in significant penalties for both the individual and the firm. A third incorrect approach, which is to seek advice from colleagues without a clear understanding of the reporting requirements, risks spreading misinformation or creating a culture of informal, potentially non-compliant decision-making. Professional judgment requires consulting established procedures and, if necessary, designated compliance personnel. The professional decision-making process for similar situations should involve a structured approach. First, identify the nature of the information received and its potential implications. Second, consult internal policies and procedures related to data handling and reporting. Third, if there is any ambiguity, Seek guidance from the designated compliance or legal department. Fourth, document all actions taken and decisions made. This systematic process ensures that all relevant factors are considered, regulatory obligations are met, and ethical standards are upheld. Question 9. Cost-benefit analysis shows that a proposed development project offers significant short-term financial gains, but preliminary environmental screenings indicate potential risks to a nearby protected wetland. The project timeline is aggressive, and there is pressure to proceed quickly. Which implementation approach best balances regulatory compliance, ethical considerations, and long-term project success? Option A. Conduct a thorough environmental impact assessment (IA) to identify specific risks and develop a comprehensive mitigation and monitoring plan, potentially adjusting the project scope or timeline to ensure compliance and minimize harm, while still pursuing the development. Option B. Proceed with the development as planned, deferring any environmental mitigation until potential issues arise, to meet the aggressive timeline and maximize immediate returns. Option C. Halt the project indefinitely due to the potential environmental risks, prioritizing absolute avoidance of any negative impact, even if it means forgoing a financially beneficial opportunity. Option D. Delegate the environmental risk assessment to a third-party consultant with minimal oversight, accepting their recommendations without independent verification to expedite the process. The correct answer is B. Proceed with the development as planned, deferring any environmental mitigation until potential issues arise, to meet the aggressive timeline and maximize immediate returns. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial benefits of a proposed project against potential long-term environmental and social impacts, which are often harder to quantify but carry significant regulatory and ethical weight. The CBRE Group Hiring Assessment Test, in its focus on implementation challenges, expects candidates to demonstrate an understanding of how to navigate such complexities within the relevant regulatory framework. The correct approach represents best professional practice because it prioritizes a comprehensive assessment that integrates environmental and social considerations alongside financial ones. This aligns with the principles of sustainable development and corporate social responsibility, which are increasingly embedded in regulatory expectations and ethical guidelines for real estate and development firms. Specifically, it acknowledges that regulatory compliance extends beyond mere legal adherence to encompass proactive risk management and stakeholder engagement, ensuring that projects are not only profitable, but also responsible and resilient. This approach fosters long-term value creation by mitigating potential future liabilities, enhancing brand reputation, and securing social license to operate. An incorrect approach that solely focuses on immediate cost savings without adequately considering environmental mitigation measures would fail to meet regulatory requirements for environmental impact assessments and potentially violate laws related to pollution control or habitat protection. Ethically, it would demonstrate a disregard for the broader societal impact of the development. Another incorrect approach that prioritizes speed of implementation over thorough due diligence, such as cutting corners on site assessments or community consultations, risks noncompliance with planning regulations, building codes, and potentially land use restrictions. This can lead to costly delays, fines, and reputational damage. A third incorrect approach that dismisses stakeholder concerns as mere obstacles to progress would be ethically unsound and could lead to significant legal challenges and public opposition, jeopardizing the project's viability and the firm's standing. Professionals should employ a decision-making framework that begins with a clear understanding of all applicable regulations and ethical standards. This involves identifying all potential stakeholders and their interests, conducting thorough risk assessments that encompass financial, environmental, social, and legal factors, and evaluating various implementation strategies against these criteria. The process should be iterative, allowing for adjustments based on new information or feedback, and should always aim for solutions that are not only compliant but also sustainable and ethically defensible. Question 10. Cost-benefit analysis shows that implementing a new, more efficient workflow system could significantly reduce operational expenses over the next 5 years. However, the initial investment in training and system integration is substantial, and there is a risk that some employees may resist the change, potentially impacting short-term productivity. Considering the need to maintain CBRE reputation for service excellence and adhere to industry best practices, which approach best balances these competing factors. Option A. Delay the implementation of the new workflow system indefinitely, citing the high initial costs and potential for employee resistance, and continue with the current, less efficient processes to avoid any short-term disruption. Option B. Focus solely on reducing headcount to offset the costs of the new system, without investing in the necessary training or change management, believing that the remaining staff can absorb the workload and learn the new system through on-the-job experience. Option C. Proceed with a rapid, mandatory implementation of the new workflow system across all departments simultaneously, with minimal training and support, to achieve cost savings as quickly as possible, assuming employees will adapt over time. Option D. Implement the new workflow system with a phased rollout, comprehensive employee training, and dedicated change management support to mitigate resistance and ensure a smooth transition, accepting a potential short-term dip in productivity for long-term gains. The correct answer is D. Implement the new workflow system with a phased rollout, comprehensive employee training, and dedicated change management support to mitigate resistance and ensure a smooth transition, accepting a potential short-term dip in productivity for long-term gains. Explanation. This scenario presents a professional challenge because it requires balancing immediate financial pressures with long-term strategic goals and regulatory compliance. The pressure to reduce costs quickly can lead to decisions that might compromise the quality of service, client relationships, or adherence to industry standards, all of which have significant implications for CBRE reputation and future business. Careful judgment is required to ensure that cost-saving measures do not inadvertently create greater liabilities or undermine the firm's core values and operational integrity. The correct approach represents best professional practice because it prioritizes a holistic and sustainable strategy. By focusing on operational efficiencies, technology integration, and talent development, CBRE can achieve cost reductions without sacrificing service quality or client satisfaction. This aligns with ethical principles of delivering value and maintaining professional standards. Furthermore, such an approach is more likely to comply with any implicit or explicit regulatory expectations regarding service delivery and business conduct, ensuring long-term viability and stakeholder trust. An incorrect approach that solely focuses on immediate headcount reduction without a strategic plan for workload redistribution or skill augmentation would be professionally unacceptable. This could lead to burnout among remaining staff, decreased service quality, and potential breaches of contractual obligations or service-level agreements, which could attract regulatory scrutiny. Another incorrect approach, such as cutting essential training programs, would undermine the professional development of staff, potentially leading to a decline in expertise and an increased risk of errors or non-compliance with industry best practices and regulations. This demonstrates a failure to uphold the duty of care expected of a professional services firm. The professional decision-making process for similar situations should involve a thorough assessment of all potential impacts, not just immediate financial ones. This includes evaluating the effects on clients, employees, operational processes, and regulatory compliance. A multi-stakeholder perspective is crucial, and decisions should be informed by data, expert advice, and a clear understanding of ethical obligations and regulatory frameworks. Prioritizing long-term sustainability and ethical conduct over short-term gains is a hallmark of professional responsibility. Question 11. Implementation of a new client onboarding process requires a junior associate to verify a client's financial standing. The client, eager to expedite the process, provides a self-attested document that appears incomplete and lacks standard verification markers. The associate suspects the document may not fully represent the client's true financial position, but the client insists it is sufficient and pressures the associate to proceed immediately. Option A. Accept the self-attested document as provided by the client and proceed with the onboarding process to avoid delaying the client's business and maintain a positive client relationship. Option B. Immediately escalate the issue to a senior manager without attempting to communicate with the client or understand their perspective, stating that the provided documentation is insufficient. Option C. Lightly explain to the client that, while the firm values their business, the provided documentation does not meet the required verification standards for onboarding. Offer to guide them on what additional information or verification methods are acceptable and necessary to proceed compliantly, ensuring all regulatory requirements are met. Option D. Advise the client that the document is unacceptable and suggest they seek professional financial advice elsewhere, without offering any alternative solutions or further assistance. The correct answer is C. Politely explain to the client that while the firm values their business, the provided documentation does not meet the required verification standards for onboarding. Offer to guide them on what additional information or verification methods are acceptable and necessary to proceed compliantly, ensuring all regulatory requirements are met. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's explicit, albeit potentially misguided, instructions and the professional's duty to act ethically and in accordance with regulatory guidelines. The challenge lies in navigating the client relationship while upholding professional integrity and avoiding actions that could lead to regulatory breaches or reputational damage for both the individual and CBRE. Careful judgment is required to balance client satisfaction with adherence to ethical standards and legal obligations. Correct approach represents best professional practice because it prioritizes transparency, due diligence, and adherence to regulatory frameworks. By seeking clarification and explaining the potential implications of the client's request, the professional demonstrates a commitment to acting in the client's best long-term interest, even if it means pushing back on an initial instruction. This aligns with the principles of professional conduct, which emphasize acting with integrity, competence, and in a manner that upholds the reputation of the profession and the firm. It also proactively mitigates risks of regulatory noncompliance by ensuring all actions are justifiable and documented. An incorrect approach that involves directly fulfilling the client's request without further inquiry or explanation would be professionally unacceptable. This would constitute a failure to exercise professional judgment and could lead to regulatory violations if the requested action contravenes established guidelines or laws. It also risks exposing the client and CBRE to potential liabilities. Another incorrect approach, such as immediately refusing the client without attempting to understand their rationale or explore alternatives, could damage the client relationship and be perceived as uncooperative, potentially leading to the loss of business. This fails to demonstrate a commitment to finding solutions within ethical and regulatory boundaries. Professionals should employ a decision-making framework that begins with understanding the client's request and its underlying motivations. This should be followed by an assessment of the request against relevant ethical codes, company policies, and regulatory requirements. If a conflict arises, the professional should engage in open communication with the client, explaining the concerns and potential consequences, and explore alternative solutions that meet the client's objectives while remaining compliant and ethical. Documentation of all discussions and decisions is crucial. Question 12. Market research demonstrates that a particular commercial property's projected rental income is significantly lower than what a prospective buyer, who is a long-term client, has been led to believe by previous, less rigorous analyses. The client is eager to proceed with the purchase based on their inflated expectations. What is the most ethical and professionally responsible course of action for the advisor? Option A. Politely decline to provide further advice on this specific transaction, citing a potential conflict of interest without elaborating on the market research findings. Option B. Highlight only the aspects of the market research that align with the client's expectations, downplaying or omitting the data that suggests a lower rental income. Option C. Present the detailed market research findings to the client, clearly explaining the discrepancy and its implications for the property's valuation and potential return on investment, while also exploring alternative strategies or justifications for the difference. Option D. Advise the client to proceed with the purchase as planned, assuming their expectations are based on insider knowledge not reflected in the current market research. The correct answer is C. Present the detailed market research findings to the client, clearly explaining the discrepancy and its implications for the property's valuation and potential return on investment, while also exploring alternative strategies or justifications for the difference. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for a specific outcome and the advisor's duty to provide objective, unbiased advice based on market realities. The advisor must navigate the potential for misrepresentation or misleading information while maintaining client trust and adhering to professional standards. Careful judgment is required to balance client satisfaction with ethical obligations. The correct approach represents best professional practice because it prioritizes transparency, honesty, and the client's best interests above all else. By clearly communicating the market research findings, even if they contradict the client's preferred outcome, the advisor upholds their fiduciary duty and avoids any appearance of impropriety. This aligns with the core principles of professional conduct, which mandate that advisors act with integrity and competence, providing advice that is sound and well supported by evidence. Specifically, this approach adheres to the ethical guidelines that prohibit misleading clients or engaging in practices that could be construed as deceptive. An incorrect approach that involves selectively presenting data to support the client's desired outcome would be a significant ethical and regulatory failure. This constitutes misrepresentation, as it distorts the true market conditions and could lead the client to make an ill-informed decision. Such an action violates the duty of candor and could expose the advisor to disciplinary action, reputational damage, and potential legal liability. Another incorrect approach, which is to simply dismiss the client's request without offering alternative, data-driven strategies, fails to demonstrate professional competence and a commitment to client service. While honesty is crucial, a professional should strive to educate the client and explore all viable options, even if they require a shift in the client's initial expectations. This approach neglects the advisory aspect of the role. A professional decision-making process for similar situations involves a structured approach. 1. Understand the client's objective and underlying motivations. 2. Conduct thorough and objective market research. 3. Analyze the research findings critically. 4. Communicate findings transparently and clearly to the client, explaining the implications. 5. If findings contradict the client's initial preference, present alternative strategies or explanations for the discrepancy. 6. Document all advice and client communications. 7. Seek guidance from supervisors or compliance departments if uncertainty exists. Question 13. Operational review demonstrates that, while conducting due diligence for a client's acquisition, you uncover documentation from a third-party vendor that, though not directly related to the acquisition's financial valuation, suggests potential non-compliance with environmental regulations by the vendor. This information was obtained incidentally during the review of vendor contracts. Option A. Ignore the information as it is not directly relevant to the acquisition's financial assessment and was obtained incidentally. Option B. Immediately report the potential environmental noncompliance to the relevant regulatory authorities, citing the source of the information. Option C. Document the finding internally and consult with the firm's compliance department and legal counsel to determine the appropriate next steps, without directly disclosing the information to the client or external parties at this stage. Option D. Discreetly inform the client about the potential environmental noncompliance of their third-party vendor, advising them to conduct their own investigation. Correct answer is B. Immediately report the potential environmental noncompliance to the relevant regulatory authorities, citing the source of the information. Explanation. This scenario presents a professional challenge because it requires balancing client confidentiality with the potential for uncovering and rectifying significant ethical breaches that could impact the firm's reputation and regulatory standing. The core tension lies in deciding how to act upon discovering information that, while not directly requested by the client, suggests a potential violation of professional standards or regulations. Careful judgment is required to navigate the duty of care to the client, the obligation to uphold professional integrity, and the potential legal and ethical ramifications of inaction. The correct approach represents best professional practice because it prioritizes a structured, ethical, and compliant response. By seeking guidance from the firm's compliance department and legal counsel, the professional ensures that any actions taken are in accordance with relevant regulations and internal policies. This approach upholds the principle of acting with integrity and competence, as well as fulfilling the duty to report potential misconduct through appropriate channels. It demonstrates a commitment to ethical conduct and risk mitigation, protecting both the client and the firm. An incorrect approach that involves directly confronting the third party without internal consultation would be professionally unacceptable. This could violate client confidentiality if the information was obtained through privileged channels, and it bypasses established internal procedures for handling such sensitive matters. Could also lead to misinterpretations or escalations that are not aligned with the firm's risk appetite or legal obligations. Another incorrect approach, such as ignoring the information due to its indirect nature or potential for client discomfort, would be a failure to act with due diligence and professional skepticism. This inaction could allow a breach of regulations or ethical standards to continue, potentially leading to greater harm and exposing the firm to significant liability. It neglects the professional's responsibility to identify and address risks, even when they are not immediately apparent or directly related to the immediate scope of work. The professional decision-making process for similar situations should involve a clear understanding of the firm's code of conduct, relevant regulatory requirements, and the principles of professional ethics. When faced with potentially problematic information, the first step should be to assess the nature and severity of the issue. If it suggests a potential breach of regulations or ethical standards, the next step is to consult internal resources, such as compliance officers or legal counsel, to determine the appropriate course of action. This ensures that decisions are informed, compliant, and aligned with the firm's commitment to ethical practice. Question 14. Operational review demonstrates that a long-standing and high-value client is seeking advice on a significant property acquisition. The client expresses a strong desire for a quick closing and has indicated a preference for a particular property, emphasizing its perceived upside potential. However, preliminary analysis suggests that the current market conditions present several significant risks, including potential overvaluation and upcoming regulatory changes that could impact the property's future value. The client has explicitly asked for an opinion that supports their optimistic outlook and encourages proceeding with the acquisition promptly. What is the most appropriate course of action for the professional in this situation? Option A. Suggest delaying the acquisition indefinitely until market conditions are more favorable, without providing a detailed analysis of the current situation or the client's specific concerns. Option B. Provide a candid and comprehensive assessment of the market risks and potential downsides, alongside the perceived upsides, advising the client to proceed with caution and potentially renegotiate terms or explore alternative options. Option C. Focus solely on the positive aspects of the property and market that align with the client's optimistic outlook, downplaying or omitting any information that suggests potential risks or delays. Option D. Advise the client to proceed with the acquisition immediately based on their enthusiasm, assuring them that any potential risks are minor and will likely resolve themselves. Correct answer is B. Provide a candid and comprehensive assessment of the market risks and potential downsides, alongside the perceived upsides, advising the client to proceed with caution and potentially renegotiate terms or explore alternative options. Explanation. This scenario presents a professional challenge because it involves a conflict between a client's immediate desire for a favorable outcome and the ethical obligation to provide accurate and unbiased advice. The pressure to retain a valuable client can tempt an individual to overlook or downplay potential risks, which could lead to significant financial or reputational damage for the client. Careful judgment is required to balance client relationship management with professional integrity and adherence to regulatory standards. The correct approach represents best professional practice because it prioritizes transparency and objective advice, even when it might be unwelcome. This aligns with the fundamental ethical principles of honesty, integrity, and acting in the client's best interest, which are paramount in the real estate industry. Providing a comprehensive and realistic assessment of market conditions and potential challenges ensures the client can make informed decisions, thereby safeguarding them from potential future losses and upholding the professional's reputation. This approach also implicitly adheres to any relevant disclosure requirements or fiduciary duties that may be in place, ensuring compliance with professional standards. An incorrect approach that involves withholding or selectively presenting information to appease the client would constitute a failure of professional duty. This could lead to a breach of trust and potentially violate regulations, requiring full disclosure of material facts. Such an action would be ethically unsound, as it prioritizes short-term client satisfaction over the client's long-term well-being and the integrity of the professional's advice. Furthermore, it could expose the professional to liability if the client suffers losses due to the incomplete or misleading information. Another incorrect approach, such as exaggerating the positive aspects of the market, without acknowledging potential downsides is also a breach of professional ethics and potentially regulatory requirements. This misrepresentation can lead the client to make decisions based on false premises, resulting in detrimental outcomes. It undermines the core principle of providing objective advice and can damage the reputation of both the individual and the firm. The professional decision-making process for similar situations should involve a clear understanding of one's ethical obligations and regulatory responsibilities. Professionals should first identify the core conflict. In this case, client expectation versus objective reality. They should then consult relevant professional codes of conduct and any applicable regulations to understand their duties. The next step is to gather all necessary information and analyze it objectively. Finally, the professional must communicate their findings clearly and honestly to the client, explaining the rationale behind their assessment and offering constructive advice on how to navigate the situation, even if it means delivering unwelcome news. This process ensures that decisions are grounded in integrity and professionalism. Question 15. Investigation of a commercial property transaction reveals a recent environmental assessment report indicating potential soil contamination, requiring further investigation. The client, eager to close the deal quickly, instructs the CBRE Group broker to proceed with marketing the property without disclosing the full details of the environmental report, suggesting only a general mention of potential environmental considerations. Which of the following represents the most ethically sound and professionally responsible approach for the CBRE Group broker? Option A. Proceed with marketing the property as instructed, providing only a vague mention of potential environmental considerations to avoid alarming potential buyers. Option B. Fully disclose the findings of the environmental assessment report to the client and all prospective buyers, advising them of the implications and recommending further expert consultation. Option C. Inform the client that the environmental report's findings must be disclosed to all parties involved in the transaction to comply with ethical and legal obligations. Option D. Advise the client that the environmental report can be withheld from potential buyers until after a sale agreement is signed, at which point it can be shared. The correct answer is B. Fully disclose the findings of the environmental assessment report to the client and all prospective buyers, advising them of the implications and recommending further expert consultation. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a favorable outcome and the professional's duty to uphold ethical standards and regulatory compliance. The pressure to secure a deal, especially in a competitive market, can create a temptation to overlook or downplay potential issues. Careful judgment is required to balance client advocacy with integrity. The correct approach represents best professional practice because it prioritizes transparency, due diligence, and adherence to the CBRE Group's code of conduct and relevant real estate regulations. This involves clearly communicating all material facts, including potential environmental concerns, to the client and prospective buyers. It upholds the principle of informed consent, ensuring all parties make decisions based on complete and accurate information. This aligns with the ethical obligation to act with honesty and integrity, avoiding misrepresentation or omission of critical data. An incorrect approach that involves withholding or minimizing information about the environmental assessment report would constitute a breach of ethical duty and potentially violate real estate disclosure laws. This omission misleads the client and prospective buyers, undermining trust and creating legal and reputational risks for both the professional and CBRE Group. It fails to meet the standard of care expected in real estate transactions, which mandates full disclosure of material facts that could affect a property's value or desirability. Another incorrect approach, such as proceeding with the sale without a thorough environmental review, ignores potential liabilities and regulatory requirements. This demonstrates a lack of professional diligence and could expose all parties to significant future costs and legal complications related to environmental remediation. It prioritizes short-term gain over long-term responsibility and compliance. A professional decision-making process in such situations should involve 1. Identifying the ethical and regulatory obligations. 2. Gathering all relevant facts, including any potential risks or concerns. 3. Communicating these facts clearly and comprehensively to the client. 4. Advising the client on the implications of the information and potential courses of action. 5. Documenting all communications and decisions. 6. Seeking guidance from supervisors or legal counsel if uncertainties arise. Question 16. What factors determine the appropriate course of action when a real estate agent discovers a potential environmental issue on a property that could impact its value, and the seller wishes to proceed with a sale without full disclosure to the buyer? Option A. The agent's personal assessment of the environmental issue's severity without necessarily informing the buyer of the potential concern. Option B. The agent's desire to close the transaction quickly to earn a commission, prioritizing the seller's immediate financial gain over full disclosure. Option C. The agent's reliance on the seller's verbal assurance that the environmental issue is insignificant and will not affect the property's marketability. Option D. The agent's obligation to fully disclose known material defects to potential buyers, as mandated by state real estate laws and ethical codes, even if it may affect the sale. The correct answer is D. The agent's obligation to fully disclose known material defects to potential buyers, as mandated by state real estate laws and ethical codes, even if it may affect the sale. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial interests and the long-term ethical and regulatory obligations of a real estate professional. The pressure to secure a deal, especially when a significant commission is involved, can cloud judgment and lead to overlooking crucial disclosure requirements. Careful consideration of all relevant information and adherence to professional standards are paramount to avoid legal repercussions and maintain professional integrity. The correct approach prioritizes transparency and adherence to the CBRE Group's ethical guidelines and relevant U.S. real estate disclosure laws. This involves fully disclosing the known environmental concern to the potential buyer, even if it might deter them. This aligns with the principle of informed consent, ensuring the buyer can make a decision based on complete information. Such disclosure is often mandated by state-specific real estate disclosure laws, which require sellers and their agents to reveal known material defects that could affect the property's value or desirability. By acting with full transparency, the professional upholds their fiduciary duty to all parties involved and avoids potential liability for misrepresentation or failure to disclose. An incorrect approach would be to downplay or omit the environmental concern to facilitate the sale. This constitutes a failure to disclose a material fact, which is a direct violation of ethical codes and likely state real estate regulations. Such an action could lead to significant legal consequences, including lawsuits from the buyer for damages, regulatory sanctions from state licensing boards, such as fines, license suspension, or revocation, and severe damage to the professional's reputation and CBRE standing. Another incorrect approach would be to rely solely on the seller's assurance that the issue is minor without independent verification or disclosure. While the seller may believe it's minor, the professional has a duty to ensure the buyer is aware of any known issues, regardless of the seller's perception of their severity. Professional decision-making in such situations requires a structured approach. First, identify the ethical and regulatory obligations. Second, gather all relevant facts, including any potential impact of the issue. Third, consult internal company policies and legal counsel if necessary. Fourth, prioritize transparency and disclosure to all parties. And finally, act in a manner that upholds professional integrity and legal compliance, even if it means a potentially lost commission. Question 17. When evaluating a client's request to execute a trade based on information they claim to have received from a close friend who works at the target company, and this information suggests a significant upcoming announcement that would likely impact the stock price, what is the most appropriate course of action? Option A. Politely decline the trade, explaining that executing a trade based on non-public information could violate insider trading regulations and that the firm cannot facilitate such transactions. Option B. Attempt to subtly discourage the client from making the trade by suggesting alternative, less risky investments without explicitly refusing the transaction. Option C. Execute the trade immediately as requested by the client to ensure client satisfaction and avoid potential loss of business. Option D. Execute the trade and then report the suspicious activity to the compliance department after the transaction is completed. The correct answer is A. Politely decline the trade, explaining that executing a trade based on non-public information could violate insider trading regulations and that the firm cannot facilitate such transactions. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's explicit, albeit potentially misguided, instructions and the professional's ethical and regulatory obligations to act in the client's best interest and uphold market integrity. The pressure to satisfy a client, especially a long-standing one, can create a temptation to overlook potential red flags. However, professionals in the financial services industry are bound by strict codes of conduct and regulatory frameworks designed to prevent market abuse and protect investors. The correct approach, which involves politely but firmly refusing to execute the transaction, while clearly explaining the regulatory and ethical reasons for the refusal, represents best professional practice. This aligns with the principles of acting with integrity, due diligence, and in the client's best interest, as mandated by regulatory bodies and professional organizations. Specifically, it upholds the duty to avoid facilitating market manipulation or insider trading, which are serious offenses with significant legal and reputational consequences. Transparency about the refusal and the underlying reasons is crucial for maintaining client trust while adhering to professional standards. An incorrect approach would be to proceed with the transaction without question. This would constitute a failure to exercise due diligence and could lead to complicity in market abuse, violating regulations against insider trading or market manipulation. Another incorrect approach would be to execute the transaction, but then report it after the fact. This is insufficient as it does not prevent the potential harm or regulatory breach from occurring in the first place. A third incorrect approach would be to attempt to subtly dissuade the client without a clear refusal, which lacks the necessary directness and could be misinterpreted, leaving the professional vulnerable if the transaction proceeds and is later scrutinized. Professionals should employ a decision-making framework that prioritizes ethical considerations and regulatory compliance. This involves first identifying potential conflicts or red flags, then consulting relevant internal policies and external regulations, and finally communicating clearly and professionally with the client, explaining the rationale for any decision that deviates from their instructions. If uncertainty remains, seeking guidance from compliance departments or senior management is essential. Question 18. Process analysis reveals a potential for significant time savings in the client onboarding workflow by digitizing several manual data entry steps. However, the team responsible for onboarding expresses concern about the initial investment in new software, the learning curve for staff, and the potential for errors during the transition. They are hesitant to adopt the proposed changes without a clear demonstration of tangible benefits and a robust support system. Which of the following represents the most professionally sound approach to address this situation? Option A. Proceed with the full implementation of the digitized onboarding process immediately, assuming that the time savings will outweigh any initial disruption and that staff will adapt quickly. Option B. Abandon the digitization initiative altogether, as the initial resistance and concerns about disruption indicate that the potential benefits do not justify the effort. Option C. Mandate the adoption of the new software and processes for all staff, providing minimal training and expecting immediate proficiency to achieve the projected time savings. Option D. Implement a phased pilot program for the digitized onboarding process with a small group of users, collecting detailed feedback and performance data to quantify benefits and identify any transition challenges before a full rollout. The correct answer is D. Implement a phased pilot program for the digitized onboarding process with a small group of users, collecting detailed feedback and performance data to quantify benefits and identify any transition challenges before a full rollout. Explanation. Scenario analysis. This scenario presents a common challenge in process optimization where a team identifies a potential improvement but faces resistance due to perceived disruption and a lack of clear, quantifiable benefits. The professional challenge lies in balancing the drive for efficiency with the need for stakeholder buy-in, managing change effectively, and ensuring that proposed changes align with organizational goals and regulatory compliance without causing undue operational risk. Correct approach analysis. The correct approach involves a structured, data-driven methodology that quantifies the benefits and risks of the proposed process change. This includes pilot testing, stakeholder engagement, and a clear communication plan. This aligns with best professional practice by demonstrating due diligence, mitigating risks through empirical evidence, and fostering collaboration. From a regulatory and ethical standpoint, this approach ensures that any changes are implemented responsibly, with a clear understanding of their impact on service delivery, client confidentiality, if applicable, and adherence to any relevant industry standards or internal policies that might be indirectly affected by operational changes. It prioritizes informed decision-making over assumptions. Incorrect approaches analysis. One incorrect approach focuses solely on the perceived efficiency gain without a thorough assessment of implementation challenges or potential negative impacts. This could lead to unforeseen operational disruptions, increased costs, or even regulatory noncompliance if the new process inadvertently violates established protocols or data handling requirements. Ethically, it demonstrates a lack of consideration for the impact on colleagues and operational continuity. Another incorrect approach is to abandon the optimization entirely due to initial resistance, without further investigation or alternative solutions. This represents a failure in professional responsibility to seek continuous improvement and could lead to the organization falling behind competitors or operating at suboptimal efficiency. It also fails to address the underlying reasons for resistance, missing an opportunity for team development and process refinement. A third incorrect approach might involve implementing the change unilaterally without proper consultation or training. This is a significant ethical and professional failing, as it disregards the expertise and experience of those directly involved in the process, potentially leading to errors, decreased morale, and a breakdown in trust. It also increases the risk of operational failure and noncompliance due to a lack of understanding and buy-in. Professional reasoning. Professionals should approach process optimization by first understanding the current state thoroughly, identifying bottlenecks and inefficiencies. The next step is to brainstorm potential solutions, followed by a rigorous evaluation of each solution's feasibility, cost-benefit analysis, and potential risks. Crucially, stakeholder engagement and pilot testing are essential to validate assumptions and gain buy-in before full-scale implementation. A clear communication strategy throughout the process is paramount. This systematic approach ensures that optimizations are effective, sustainable, and aligned with organizational objectives and ethical standards. Question 19. Benchmark analysis indicates that certain operational workflows within CBRE Property Management Division are experiencing significant delays and increased resource allocation compared to industry averages. To address this, a new initiative is proposed to streamline these processes. Which of the following approaches best aligns with best professional practice for process optimization in this context? Option A. Conduct a comprehensive review of existing workflows, involving key personnel from the property management teams to identify bottlenecks and gather insights for improvement, followed by a phased implementation of data-driven solutions with adequate training and support. Option B. Focus solely on reducing headcount within the property management division to cut costs, believing that a leaner team will naturally become more efficient. Option C. Immediately implement a new, cutting-edge software system that promises significant automation, assuming it will resolve all identified delays without requiring extensive user training or integration planning. Option D. Adopt the process optimization strategies of a direct competitor without a thorough analysis of their applicability to CBRE's specific client portfolio and operational structure. Correct answer is A. Conduct a comprehensive review of existing workflows, involving key personnel from the property management teams to identify bottlenecks and gather insights for improvement, followed by a phased implementation of data-driven solutions with adequate training and support. Explanation. This scenario presents a professional challenge because it requires balancing the drive for efficiency with the imperative to maintain service quality and client trust, all within the specific regulatory environment governing CBRE operations. The pressure to optimize processes can sometimes lead to shortcuts that inadvertently compromise compliance or client satisfaction. Careful judgment is needed to identify optimizations that are both effective and ethically sound. Adhering strictly to the CBRE Group hiring assessment tests implied regulatory framework, which we will assume for this exercise, aligns with general principles of professional conduct and data privacy common in the real estate services industry, without referencing specific external laws. The correct approach represents best professional practice because it prioritizes a holistic review of existing workflows, actively seeking input from those directly involved in the processes. This collaborative method ensures that proposed changes are practical, sustainable, and address the root causes of inefficiencies rather than superficial symptoms. It also fosters buy-in from staff, reducing resistance to change and improving the likelihood of successful implementation. This aligns with ethical principles of transparency and fairness in operational management, ensuring that improvements benefit all stakeholders, including employees and clients, without compromising service delivery standards. An incorrect approach that focuses solely on cost reduction by eliminating roles without a thorough impact assessment would be professionally unacceptable. This fails to consider the potential degradation of service quality, increased workload on remaining staff leading to burnout, and potential breaches of client service level agreements. Ethically, it demonstrates a disregard for employee well-being and a lack of due diligence in understanding the full implications of such a drastic measure. Another incorrect approach that involves implementing new technology without adequate training or integration planning would also be professionally flawed. This can lead to operational disruptions, errors, and a failure to achieve the intended efficiency gains. It also risks alienating staff who feel overwhelmed or unsupported, and could negatively impact client experience due to system glitches or reduced responsiveness. This approach lacks foresight and a commitment to proper change management, which are crucial for successful process optimization. A third incorrect approach that involves benchmarking against competitors without understanding the unique context of CBRE operations and client base is also problematic. While benchmarking is valuable, blindly adopting competitor strategies without adaptation can lead to misaligned goals and ineffective solutions. It fails to recognize that what works for one organization may not work for another due to differences in market, client needs, and internal capabilities. This approach lacks critical analysis and strategic thinking. The professional decision-making process for similar situations should involve a structured approach. 1. Define the problem and desired outcomes clearly. 2. Gather comprehensive data and insights from all relevant stakeholders. 3. Analyze root causes of inefficiencies, not just symptoms. 4. Develop a range of potential solutions, evaluating each for feasibility, impact, and alignment with ethical and regulatory standards. 5. Prioritize solutions based on a balanced consideration of efficiency, quality, cost, and employee/client impact. 6. Implement changes with robust planning, communication, and support mechanisms. 7. Monitor and evaluate the effectiveness of implemented changes, making adjustments as necessary. Question 20. Cost-benefit analysis shows that implementing a new automated client onboarding system could significantly reduce administrative overhead. However, this system would require a reduction in the number of human touchpoints during the initial client engagement phase, which approach best balances efficiency gains with maintaining professional standards and regulatory adherence. Option A. Reject the automated system entirely, prioritizing the current level of human interaction to avoid any perceived degradation in client service, despite the potential cost savings. Option B. Implement the automated system, but conduct a pilot program with a select group of clients, gathering feedback on their experience and assessing any potential compliance gaps before a full rollout. Option C. Introduce the automated system gradually, replacing manual processes one by one, without a formal pilot or comprehensive client feedback mechanism to minimize disruption. Option D. Proceed with the automated system, focusing solely on the projected cost savings and assuming clients will adapt to fewer human interactions. The correct answer is D. Proceed with the automated system, focusing solely on the projected cost savings and assuming clients will adapt to fewer human interactions. Explanation. This scenario is professionally challenging because it requires balancing efficiency gains with potential impacts on service quality and regulatory compliance. The core tension lies in optimizing processes to reduce costs without compromising the integrity of client interactions or adhering to industry standards. Careful judgment is required to ensure that cost-saving measures do not inadvertently create risks or violate established protocols. The correct approach represents best professional practice because it prioritizes a holistic review that considers all stakeholders and potential ramifications. It acknowledges that process optimization is not solely about cost reduction, but also about enhancing value and maintaining compliance. By involving relevant departments and seeking feedback, this approach ensures that changes are well-informed, sustainable, and aligned with regulatory expectations and ethical obligations. This proactive and collaborative method mitigates risks and fosters a culture of continuous improvement that is both efficient and responsible. An incorrect approach that focuses solely on immediate cost reduction without considering the downstream effects on client service or data integrity would be professionally unacceptable. This could lead to regulatory breaches if, for instance, reduced staffing impacts the ability to meet service-level agreements or handle client inquiries within mandated timeframes. Ethically, it could be seen as prioritizing profit over client well-being and professional duty. Another incorrect approach that implements changes without proper testing or validation risks introducing errors or inefficiencies that could negate the intended cost savings and potentially harm client relationships or lead to compliance issues. This demonstrates a lack of due diligence and a failure to adhere to best practices in change management, which are often implicitly or explicitly guided by regulatory frameworks emphasizing accuracy and reliability. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the objectives of the optimization, e.g., cost reduction, efficiency improvement, enhanced client experience. Second, conduct a thorough impact assessment, considering operational, financial, regulatory, and ethical implications. Third, engage relevant stakeholders for input and feedback. Fourth, develop and pilot potential solutions, carefully monitoring their effectiveness and any unintended consequences. Finally, implement changes incrementally and establish mechanisms for ongoing review and adjustment, ensuring continuous alignment with organizational goals and regulatory requirements.